Lululemon shares have skyrocketed over the last 5 years, rising nearly 300%. But Wall Street analyst says that astronomical growth might not be sustainable year after year anymore, writing in a note to clients this week, quote, "It's time for a reality check on shares of the popular athleisure brand." Joining us now is the analyst behind that call, Bernstein's Aneesha Sherman. Nice to see you. So why? What has changed? Is it the company? Is it the economy? Or is it both?
It's a little bit of both. So Lulu has been, as you said, a phenomenal growth story. It has grown at a 25% compound annual rate for the last 5 years, which is really significant growth. But two things have changed. One is that the catalysts that drove that growth have run out. There was a catalyst of e-commerce investment and e-commerce growth. There was a catalyst of COVID, where we wore athleisure at home for a year and a half. And then this year has been the year of revenge spending and kind of getting out for social occasions and wearing more lifestyle and shoes and belt bags, and those have been highly successful products. We don't see a catalyst like that for 2023. And on an $8 billion business, it's not going to maintain that clip. So we have it slowing down materially to kind of slightly below mid-teens growth for this year. And the problem with that is that the top line growth drives all of the earnings growth. So a deceleration there is going to drive a deceleration in the earnings profile as well, which we think we'll have from about 33% last year to more like mid-teens this year.
And Aneesha, a challenge that Lululemon has been dealing with now for a couple of quarters is the inventory pileup. It was what, 85% in the third quarter. Are you seeing any improvement, or I guess how long until we see an improvement there? And what does that signal just in terms of promotional activity that's going to be necessary down the road?
Yes and no. So we will absolutely see sequential improvement. Management has targeted getting to a 60% year over year increase, down from that 85 by the next quarter. They're doing a lot of clearance right now. If you go into their stores, if you go on their website, you'll see a lot of product in there. We made too much section. So they are trying to clear that inventory. However, this is a brand that does not like to promote too deep. You know, they don't like to do too many markdowns. They try to keep their full price profile. So they're not going to be doing aggressive clearance the way we've seen from some of the other brands. And so, yeah, they're going to carry a higher inventory balance for several more quarters before it gradually normalizes as they buy less product and sell through what they already have. So it's going to be a slow wind down over the next year or more.
Their latest push was both in women's athletic shoes and, of course, the fitness equipment, the mirror. How successful were those, or do you expect them to be down the road?
I don't think either one has been particularly successful. Shoes is a very competitive category. It's got big giants like Nike that dominate market share, that dominate top of mind awareness and brand loyalty. And it's also a difficult product to get into. You need R&D, you need credibility around performance. So it's a hard one for new entrants, especially Lululemon, because it has credibility in apparel, not in footwear. So, we've seen a lot of the footwear on clearance at the end of year sale. That clearly seems like sales have not been at the level that management expected based on kind of what we've seen on their promotions. And then the mirror product was bought at the peak of COVID when we thought connected fitness would be a trend that lasted forever. When we look at mirror compared to the market leader Peloton, Peloton is over 20 times the size and is still not profitable. So I don't think mirror is ever going to be profitable on its own. The way Lulu is thinking about it now is as a customer acquisition tool. So, you come into you purchase the membership, you try out Mirror, and soon you become a long-term customer of Lululemon's apparel. But I would argue there are cheaper and more higher return ways of attracting new customer acquisition than purchasing this brand. So I don't think either one is going to be particularly successful or money-making.
Aneesha, you mentioned Peloton. Let's talk about it. You also covered that stock. They have earnings out next week. Shares clearly have been under a tremendous amount of pressure over the last 2 years. In the last year alone, stock off nearly 50%. You wrote in a recent note that you are more bullish than ever on Peloton. Why?
Yeah, so Peloton, speaking of reality check, Peloton had a big reality check coming out of COVID, where, the level of demand that it was seeing significantly dropped. the price tolerance for paying $2,500 for a bike, started to run out, and their sales started to dwindle on really tough comps. And so they've taken their medicine, they've done what they needed to do to fix the business. OpEx has been cut by half quarter-over-quarter. They've cut down marketing, they've shut down showrooms, they've outsourced some of their manufacturing to try to make their cost base less fixed and more variable, so it's more responsive to demand. They've made some headcount reductions. They're selling a facility that they thought they would need, and turns out they don't need that much manufacturing. So they've made a lot of changes. We haven't seen the impact of those changes in profitability yet because there have been a lot of one-off costs. But once you strip out those one-off costs, you see that margins are improving. They're going to be free cash flow positive by the end of this fiscal year is what they've targeted, and I think there's a reasonable chance of getting there. And most importantly, the core business, the subscription business, still shows healthy metrics. I mean, churn is still below 1.5%. That is lower than kind of the cable companies, the phone companies, subscription businesses like that. Engagement, when you look at kind of user engagement, use of the app, that remains at all-time highs. So they do have a healthy core. They just needed to fix their cost base and reset, and I think they have done that.
All right, nice to hear. Got in 30 minutes on the bike this morning. Aneesha Sherman, nice to see you. Have a good weekend.